Hi friends, this is my monthly video for the month of November, and in such videos I bring key insights from stock market, mutual funds and IPOs, bringing you latest trends. Important video, please do not skip it. So let's start from the stock market first. Have a look at my screen and you will see that in the month of November, Nifty made its bottom at 23,300 sort of a level. At that time in the market, there was a lot of hoo-ha that Nifty can fall by another 10%, taking that overall fall to 20%. I had created a video at that time. The video is still there on my channel speaking about why I believe that Nifty could not go down to 20% level. Please go and watch that video. You are going to learn a lot in that video. But coming back to what has happened in the month of November, Nifty had made its bottom at 23,300 level. But more importantly, what is likely to happen in the next few weeks? I'm not going to speculate here, but will give you some data-driven analysis. First point that we need to understand is that this market has absorbed three big bad news. Let me break it down for you. First bad news came out from GDP perspective. All of you might have heard that GDP growth in the September quarter came out to be only 5.4%, which is the lowest in the last 7 quarters. Now this is a very bad news because GDP like India, when it was growing at a rate of 6 to 8%, as you can see here in the chart, all of a sudden it comes down to 5.4%, typically would have created some sort of panic in the stock market and stock market would have fallen. But what happened to stock market? It did not fall at all. In fact, it started to recover from here, and right now when I'm recording this video, Nifty is trading at around 24,700 level. Second bad news that came out in the month of November was Adani Group stocks falling badly because of the allegations towards Adani Group. Now news like these could have detrimental impact on stock market because foreign investors may start to lose their faith in Indian equities. But what happened again? This bad news was easily absorbed by the market, and market did not go to like 21,000, 22,000 level, which is what the panic was at that time. And now comes the third bad news, which is that FIIs have been continuously selling in Indian stock market in the month of November as well. 45,000 crores of net selling happened by FIIs. But I'll tell you one important thing here, that towards the fag end of November, FIs started to buying Indian equities. For example, here, have a look at my screen. You will see 25th, 26th, 27th November, there has been some buying. So overall, FIs exiting the Indian stock market was a bad news, but market pretty much absorbed all these three big news that was out there in the month of November. Now, what is likely to happen in the market for the next 2 to 3 months? Let me give you my analysis. Now, if Indian stock market needs to give us a short rally, there are 3 possible triggers that need to be in place for this rally to trigger. Point number 1 here is that Indian government's capex spending. So have a look at my screen and you will see that Jefferies are forecasting that in the second half of the year, Indian government is likely to spend 25% more on capex in the remaining 4 to 5 months left in the year now. Now just a background here, Indian government's target was to spend 11 lakh crores on the capital expenditure for the entire year. But in the first 6 months, that is from April to September, they only spent 37% of this money because of various reasons such as elections, monsoons, etc. But now Jefferies is projecting that this capex spending is likely to go up because Indian government is likely to spend more money. So the remaining 67% money, if Indian government spends in the remaining 4 to 5 months now, then what is likely to happen? That this spending is likely to trigger more projects coming to Indian companies, and therefore their revenues, profits are likely to grow, and more importantly the sentiments are going to get lifted. So in my view, if Indian government decides to spend all of this money or majority of this money, then we are likely to see a short rally in the Indian stock market. Now of course we do not know whether Indian government is likely to spend this much of money or not, but this is one trigger that can potentially trigger a short rally in the Indian stock market. The second key trigger point is that in the month of January, Donald Trump is going to assume the seat or the charge of US president, and what is likely to happen in my view is that India stands to gain more than lose because of China losing when it comes to trade and fiscal policies that the US government is likely to announce. Again, I do not know what sort of policies will come out. We are likely to see all of that starting to come from the month of January, but in my view, India stands to gain. In fact, I had created a separate video on this topic talking about which sectors are most likely to gain and lose when it comes to Indian stock market. Please go and watch that video. You are going to learn a lot. And the third key point that we need to understand is that FIs are likely to return to Indian stock market at some point in time. I do not know when, but the early signs are already there. So if I show you the data of the first few days in the month of December, what do you see here? Almost net buying of around 13,700 crore as of 5th of December close of play is what we see. Continuous buying in the last 3 days. At the time of recording this video, I'm recording on 6th of December here. But if you look at the last 3 days of data, you will see that there is a continuous buying by FIs. Are they already coming, or is this the Santa rally? I do not know. But the point here is that when the US market good news starts to fade, FIs are likely to return back to India. And when that happens, typically Indian stock market are likely to perform better. So in my view, these are the 3 triggers. I do not know whether all 3 will play out or none of these will play out. But at least I have a thesis here that if these 3 trigger points play out, we are likely to see a short rally. But please understand, in the long term, markets are driven by valuation. In the short term, markets are driven by sentiments. If you like this analysis, hit the like button. Let me know in the comments a simple thank you. It will motivate me to bring such content for you at zero cost. Also, if you practically want to learn investing in various asset classes, then consider joining my YouTube member community. I post almost on daily basis, bringing you key insights that will help you make better investing decisions. You are going to learn practically. The feedback of this community has been excellent. Go and simply press join button on my channel, or you will find the link in the description or in the pinned comment. With that, let's move to very important trend that is playing out in mutual funds. I'll present you some data, and this is something that most people are missing out in terms of trends. So please make sure you watch the next 3 to 4 minutes to learn about mutual funds a lot. Moving on to mutual funds, very interesting trend that is playing out right now in mutual funds is what we need to understand. So have a look at my screen and focus on this column called net inflow outflow during the period which is April to June 2024, and you will very quickly note that sectoral mutual funds have got 46,000 crores of net injection into it, right? Followed by the second one, which is the multi-cap mutual funds. Almost 10,000 crores of money has been invested in the multi-cap mutual funds. Now have a look at this period, which is July to September of 2024. Again, a very similar trend here that sectoral mutual funds got 49,000 crores and multi-cap mutual funds got the second highest allocation, which is 13,000 crores of investments. Now, sectoral mutual funds are not for everyone, because for you to invest in sectoral mutual funds, you really need to get the entry and exit points right. Therefore, I am more interested to bring you some more insights from the multi-cap mutual fund space. Now, there are a couple of reasons why multi-cap mutual funds are becoming so popular. Number one is that they genuinely offer the true diversification, because 25% of the money they need to put in large cap, 25% in mid cap, and 25% in small cap. This is a regulatory requirement. But more importantly, the second key reason I think multi-cap mutual funds are gaining popularity is because they've hit the sweet spot of balancing risk and reward. So have a look at my screen and you will see that multi-cap mutual funds, they offer better returns than large cap and large and mid cap category, while the risk involved in multi-cap mutual funds is lesser than mid cap and small cap mutual funds. And this is the sweet spot that many investors are right now going for, and therefore you see the popularity of multi-cap mutual funds. Now let me also have a look at returns here. So if you look at the index level returns here, multi-cap mutual funds have offered in the last 5 years 23% CAGR returns, which is much better than Nifty 50 large cap space, which is around 15%. But if you compare with mid cap and small cap, mid cap has offered 28% CAGR, small cap has offered 30% CAGR, but of course they are more riskier and volatile. Therefore, multi-cap sit right in between when it comes to the risk and reward ratio. Now comes the most interesting point about multi-cap mutual funds. Should you go for active mutual funds or passive mutual funds? So here is the data that 77% of active mutual funds have managed to beat the index return in the last 1 month. 75% has managed to beat in the last 6 months. So the trend seems to be that we need to pick the active multi-cap mutual funds rather than relying on the index. Now, I was extremely curious to understand why is it that the active multi-cap mutual funds are performing better than the index multi-cap mutual funds, and here is something interesting that I found. And for me to explain this in a very easy to understand language, I am going to take an example. So I was going through Grow Multi-Cap Mutual Funds NFO that is going on right now, and I was going through their document, and what I found is that Grow's mutual fund is going to allocate 25% to large cap, 25% to mid cap, and 25% to the small cap space, because that is a regulatory requirement. But here comes the interesting part, that the remaining 25% is the key to generate alpha by the active multi-cap mutual funds. Because depending on where the AMC will deploy this remaining 25% of funds will decide whether this AMC is going to generate alpha or not, which is the additional returns on top of the index returns. So let me give you the example of Grow Mutual Fund. When I was reading their documents, I found that what they're saying is that they are going to allocate this remaining 25% to the growth opportunities, irrespective of whether it's a large cap, mid cap or small cap. Now, what are these growth opportunities? There are two key points we need to understand as an example here. Now, in case of Grow's multi-cap NFO that is going on, their aim is to get into the export related stocks. Why? This is because the AMC believe that there is going to be a resurgence in the export related stocks, mainly because China's dominance is reducing in the export related activities. Indian government is supporting the exports and also the cost of capital is getting reduced. Secondly, Grow Mutual Fund will look to find growth opportunities in consumption play, especially premiumization in real estate, auto and jewelry. Again, I'm not saying that Grow's mutual fund is going to create alpha or not in the future, but the point here is that the remaining 25% is going to decide whether the AMC is going to generate alpha or not. Again, by no means it is a recommendation, but I have given you this example to make sure that whenever you are picking up any active multi-cap mutual funds, try to find out where is the remaining 25% money is going to get allocated, because that is where the key to generate alpha lies. Now, in the next 3 to 4 minutes, let me cover two important IPOs that are coming. These are not recommendations. It will give you a lot of information for you to make some decisions. So the first one is the Vishal Mega Mart. It is going to open on 11th of December. The price band has been established between 74 to 78 rupees. It is going to be 8,000 crores of IPO, which is only for sale, offer for sale. It is not a fresh issue at all. Now, I was going through their RHP document, and what I found is that if you look at their revenues in the last 2 years, the revenues have grown by almost 26% of CAGR. And if you look at the profits have been growing at around 50% of CAGR, which in my view is a very, very good growth rate. Their same store sales growth has been in double digits, which in my view is a very, very good growth rate. Now, Rahul, how's the retail sector anyways going to grow in the next few years? So the forecast is that retail sector is going to grow at around 20% CAGR between 23 and 2028. But more interestingly, the tier 2 cities are going to grow at a higher speed, which is at around 32% CAGR. Again, these are some forecasts. These are not guaranteed growth at all, but these are some good numbers that we need to know. But more importantly, if you look at Vishal Mega Mart, you will see that they have been opening stores at a higher speed in tier 2 cities, mainly because they want to tap into tier 2 cities. Because if you look at the speed at which these stores have been opened in tier 2, it is at 12% CAGR versus 6% in tier 1 cities. If I look at the broad categories that the Vishal Mega Mart sells, you will see that 43% of their revenues have come from the apparel section, 27% from FMCG, and remaining 28% from general merchandising. And what does this tell us? This tells us that there is no concentration risk here from a product categories perspective. Now, if you compare them with their competitors, companies like Reliance Retail, Avenue Supermart, Trent Limited, you will see that they sit somewhere in between in terms of the growth. So if you look at the 1 year growth from revenues perspective, they are sitting at 17%, while Reliance did 32% in 2023. Avenue Supermart 19%, Trent did 50%, right? From a profit growth perspective, they are sitting at 44% in the year 2024 versus Reliance 30% in 2023. I don't know why they took 2023. They may not be able to find 2024 data. But anyways, this is what is there in their RHP. D-Mart or Avenue Supermart only grew by 7% from a profitability perspective, and Trent has grown by almost 275%. So the point here is that they sit somewhere in between the fast growing companies like Trent and slow growing growth companies like Avenue Supermart. Now, in terms of the valuation, post IPO, the PE ratio is likely to be around 70 and the PB ratio is likely to be 6.23. How does it stack from an industry perspective? So have a look at my screen. You will see the PE ratio of retail industry is at around 52, but most of the other retail companies are trading well above the industry PE. From a PB perspective, it looks like 4.86. And again, here, most of these retail companies are trading at a higher PB ratio than the industry PB. So that's all on Vishal Mega Mart. This is not a recommendation. I hope you like this insight. Let me now cover the second IPO as well. The second IPO that I want to cover is a SME IPO, a company called Emerald Tire Manufacturers. SME IPOs are generally more riskier than the main board IPOs because of various reasons that I'm not going to go in this video, but I just wanted you to be aware of that. Now, coming back to this IPO, the price band is 90 to 95 rupees per share. Lot size is 1200 shares. The IPO is already going on at the time of recording this video. It in fact closes on Monday 9th of December. It's almost 49 crores of total issue size, out of which 47 crore is fresh issue. So mainly it is a fresh issue. There is a OFS part as well, which is around 1.89 crores. Now for retail retail people, one lot will be 1200 shares. So minimum investment required in companies like this is almost 1,14,000 rupees. If I now speak about their financial information, in the last 2 years, the revenues have grown by almost 13% CAGR, but the profit after tax has grown by almost 58% CAGR. Company manufactures 4 types of products: solid tires, number 2 press on bend, number 3 industrial pneumatics, and number 4 wheel rims. But more importantly, majority of their revenues come from export rather than domestic sales. If you look at the profitability and valuation metrics, for example, ROCE is at 15.84%. If you look at the valuation, PE ratio is likely to be 15, and if you look at the industry PE ratio for the tire manufacturing companies, it is at around 30. The PB ratio of this company is around 2.55, while the industry PB is at around 3. If I speak about the subscription status as of 6th of December at around 11:43 am when I'm recording this video, you will see that overall it is oversubscribed by 65 times. Retail investors have subscribed by almost 102 times, while qualified institutions is only 0.52 as of now. Again, qualified institutions generally do a lot of subscription towards the end of the IPO. In terms of the anchor investors, HDFC Bank, Kingsman Wealth, etc. are some good names that you can find. Again, not a recommendation here, but I have given you some meaningful information for you to go and do further research on this particular IPO. So finally, in this video, I've covered a lot of information, starting from stock market to mutual funds to IPOs. If you like this video, please hit the like button. Let me know in the comments a simple thank you. Also, please let me know, should I continue with these monthly videos or not? And lastly, if you want to practically learn investing, you can join my YouTube member community. I post almost on a daily basis, bring you a lot of insights that will help you become a better investor. With that, I hope to see you in my next video. Until then, keep rocking.